One of the best things we ever did was we pivoted how we were raising the capital. Instead of the fund, super high level, the way we set the fund up, every dollar of revenue that comes in, aside from a small admin fee, gets split 50-50 between the GPs and the LPs. Period, end of story. That's why it doesn't matter if I charge origination fee or rate, because they're getting a piece of the action either way. That's very different than other fund structures, generally speaking. Typically, the manager keeps the origination fee, and the interest is split between the LPs and GPs. That's not how we were setting it up. We did that so that it could boost the returns, or the returns go up because we're sharing in more of it, and we needed to be more generous to attract investment because we're rookies. And so it wasn't like now splitting that revenue and everything 50-50 is great because it aligns all the incentives. And that's been like a cornerstone of Dynamo Capital. But we got there by accident. That was just so we could sell the investment easier to have a higher return. And so our pro forma showed like 24% net to the investor.
Wow.
And yeah, your face kind of said it all, right? Everybody was like, yeah, that's stupid. That's not real. Like immediately they assume there's a lot of high risk associated with it and, blah, blah, blah. And we don't have a track record to back it up. We just have like kind of a gut feeling that it's going to work. And so what we did decide instead was like, okay, fine. We'll take debt at the manager and then bet on ourselves. Because if we're 50-50, our top line is 48% according to the pro forma. If I give you 12% fixed in return, investment into the manager, and we invest it from there, in theory, we should be taking home 3/4 of the return. We're betting ourselves and we're kind of doubling down. That worked. It worked out for the interim that we did it. And it was a good way for us to jumpstart the fund because we ultimately couldn't raise any money otherwise. You're asking investors who were very seasoned to invest in a variable rate return from a couple of rookie managers who have never done this before. I wouldn't have given myself the money either. I had a compelling story. Justin and I had a compelling story, but it wasn't necessarily investable. But they did like the fixed return. So we agreed to 1% a month. We kicked that out. And it's kind of history from there. And so that's how we started raising. For our first full year, we did 30 net to the investor. That was a disgusting capital utilization rate that we were at. Certainly, I did not have this kind of gray beard before. It was very stressful for us. We were spending money as soon as it came in, but we had a lot of demand, and it was kind of good, proof of concept. In 25, we took a much more measured approach to how we would go about it, tried to smooth out the return for the investors. I mean, in 2024, we had some months that were 7% net back to the investor that month, and then, half a point the next month. It's because we spent all the money in one month, and then we didn't have any for the next month, right? It's just boop, boop, boop. And we wanted to smooth that out in 25. So we did that. In 25, we finished just north of 21% net to the investor on the 50-50 split. So, we're doing 42 top line, which is, phenomenal. We're very happy with that. We've had to grow the fund tremendously, both in terms of capital raise that we've got. So we're north of a $115 million fund today, and right around $65 million in checks cashed in equity in the fund. And then the rest is lines of credit and facilities on top of that we manage. But one big thing for us is that we don't charge an AUM fee. We don't charge an assets under management fee. Justin and I certainly could. It would change the split, obviously, but, we don't see a reason that just because we carry a line of credit, that we get paid for it. And again, that goes back to the alignment of incentives thing. So it just really speaks to our philosophy. It's made raising capital easier and easier because we've had proven track record now of it working. We've had a lot of people convert that debt into the LP position because it's performing better than the debt, obviously. And, I think our investors, first and foremost, like that we were betting on ourselves and that we were taking the risk. Still to this day, Justin and I personally guarantee every dollar that's in the fund and every loan that's in the fund. So we put our money where our mouth is. Our whole team operates like it's their. We have 35 or 36 employees today, depending on start dates, and we're continuing to grow. And every one of them operates like this fund is theirs. Because ultimately it is, if the fund is here and it's performing well, then they continue to have jobs, and they really do operate in a way that we feel just incredibly comfortable with everybody, being a face of the organization, because they are. In their particular fields, whether it's processing, servicing, underwriting, they interact with borrowers and investors and clients, and they ultimately represent Dynamo at every level. It's not just me and Justin that are in front of everything. I do a few of these podcasts here and there, but it's not like I'm talking to every client. They really are the representation of this company, and they've all been very much in the image of what we wanted Dynamo to be, and even beyond what we could have came up with.
I love that. It's definitely the mix of like the math and the people, right? It's all that together. Now, one other thing I think would be helpful for the listeners is, you had that initial fundraise, and something you've alluded to is how you are effectively leveraging with things like lines of capital and other things like that, in the same way that an investor who's used to buying doors and, doing single family rentals or something like that, they're leveraging with that mortgage. Can you speak about what that looks like on a private lending standpoint?
It's really no different, to be honest. I mean, high level, and this is you'll see the extent of my knowledge versus what Justin does for us. I do the talking, he does the thinking. So the easiest way that I can explain it, if you utilize a line of credit or a facility, then there's a bunch of different kinds of facilities, but let's just broadly call them lines of credit. I'm sure Justin will cringe about how I call it a line of credit. If you're using a facility, you can fund $1 of loan for a fraction of that dollar, generally speaking. So as we've matured and gotten a better track record, we've gotten better facilities. In the past, we were able to fund a dollar of loan for 33 cents. Today we're able to fund it for 25 cents. As we get better and better and bigger and bigger and command more advance rate, then you can fund it for less. And so that allows us, I can raise $1 of investment and I can do $4 of loans for it, which obviously leverages the fund in a way, or levers the fund in a way that we're able to outpunch the equity that we've raised, and that's what pumps up the return.